You're about to uncover the principles of the man who laid the foundation for Warren Buffett's legendary investing approach. A brilliant mind who devised strategies that transformed the world of investing forever. His name, Benjamin Graham. His approach, a method so effective it shielded investors during the Great Depression and still holds up in today's markets. And the best part? You can master it yourself. But before we dive into how to apply it, let me ask you something. Have you ever heard of someone losing all their money in stocks because they acted on gossip or so-called expert hot tips? That's exactly the kind of mistake Graham's strategy was designed to avoid. While most people rushed to buy whatever was popular, Graham chose a completely different path. He introduced a powerful concept known as the margin of safety. This single idea earned him the title Father of Value Investing and made him the mentor of many of history's top investors. So, how did Graham develop a method that still helps people avoid financial ruin? To understand that, we need to look back, and I'll break it down for you in just a moment. Stick around, because this could permanently transform your investing mindset. In the early 1900s, Benjamin Graham grew up in a family that fell on hard times when he was still young. After once living comfortably in New York, his family ended up facing poverty. These struggles sparked his determination to never lose money simply because he didn't grasp how markets worked. As he matured, Graham's exceptional talent for math became obvious. He graduated ahead of schedule from Columbia University, a prestigious American institution. Soon after, he started working on Wall Street, the heart of the financial world. On Wall Street, Graham quickly stood out for his meticulous analysis of companies. Digging deep into financial statements to find the real value of businesses, something few others were doing. Then, in 1929, disaster struck. The stock market crashed, leading to the Great Depression. Millions of people were wiped out. Families lost their homes, jobs disappeared, and banks went under. Panic spread like wildfire. Investors dumped their stocks in desperation, selling at any price. It was absolute chaos. Graham, who also suffered losses, refused to stand still. Instead, he doubled down on research. He was determined to find a way to protect investments even when markets were falling apart. That's when he developed his revolutionary margin of safety principle. It's a simple yet powerful idea. Only buy a stock if it's priced far below what the business is truly worth. This built-in cushion protects you from large losses if things go wrong. Think of it like having an airbag in your car. It softens the blow in a crash. Another key insight from Graham was his metaphor of Mr. Market. He imagined the stock market as a moody business partner who offered to buy or sell shares every day at wildly different prices, depending on his emotions. Some days, Mr. Market is overly optimistic, pricing stocks sky high. Other days, he's pessimistic, practically giving them away. Graham taught investors to ignore these mood swings, to buy when Mr. Market is fearful, and to avoid getting swept up when he's overly enthusiastic. This approach revolutionized investing. Instead of blindly following trends or rumors, people began focusing on hard data and company fundamentals. Graham also emphasized that markets often behave irrationally. Driven by fear and greed, they fluctuate unpredictably. But over time, he believed the true value of solid businesses shines through. Meaning patient investors who buy strong companies at bargain prices usually come out ahead. Here's an example to make it clearer. Imagine you calculate a company's shares should be worth $100. But because the market is panicking, they're selling for just $60. If you buy at $60 and wait, when confidence returns, the price is likely to rebound toward the company's real value, and you profit. Simple, but powerful. However, Graham always warned against putting all your eggs in one basket. He advocated diversification, owning shares in multiple companies so that if a few go south, others can balance out your returns. This method safeguarded investors' wealth during even the worst market crises. The intelligent investor, one of the most influential investing books ever written. And these same teachings became the foundation of his classic book. In it, Graham explained how to dissect a company's financials, estimate its true worth, and avoid emotional pitfalls in the market. Warren Buffett, who studied under Graham, often credited this book with completely reshaping his understanding of safe and successful investing. You might be wondering now, how did Graham actually determine a company's worth? And how can you use these same ideas today, even if you're not a finance professional? Let's break it down step by step in the next section, where I'll show you exactly how Graham analyzed companies to uncover opportunities others missed. Stay tuned. This could be your first step toward investing like the pioneer of value investing himself. You've already seen how Benjamin Graham's tough childhood and the chaos of the Great Depression inspired him to build a safer way to invest. But how did he actually figure out whether a stock was a bargain or overpriced? Let's unpack his method step by step so you can start using it yourself. First, Graham developed the idea of intrinsic value, the actual worth of a company based on factors like its profits, its assets, and long-term performance. His key insight was to compare this true value with the stock's current market price. If shares were selling for significantly less than what he calculated they were worth, he called the difference a margin of safety, a built-in buffer that reduced your risk if things went wrong. So, how can you estimate this margin of safety yourself? Here's a simplified version of Graham's process. 1. Calculate average earnings. Add up the company's earnings per share for the past 5 years, then divide by 5. This smooths out any unusually good or bad years, giving you a more reliable picture of the company's performance. Example: if earnings per share were $4, $5, $6, $5, and $6, the average would be $5.20. To estimate the fair value, multiply the average earnings by a multiplier. Graham suggested using 8 to 10 for stable businesses. So, in our example, $5.20 times 10 equals $52. That means the stock's fair, or intrinsic value, is around $52. 3. Compare with the market price. Look up the current share price. If it's trading at $30 while your estimated value is $52, there's a margin of safety of over 40%. That's like buying a $100,000 house for $60,000, giving you a cushion if things go south. But Graham didn't stop with just price and value. He also checked a company's debt levels. If a business owed more than it could reasonably pay back, he stayed away because too much debt can quickly lead to bankruptcy during tough times. He also studied the company's earning stability. If profits swung wildly year to year or there were frequent losses, Graham saw that as a red flag. Stable or gradually rising earnings signaled a healthier, more reliable business. Another golden rule from Graham: never invest in businesses you don't understand. If you can't easily explain how a company makes its money, it's probably best to skip it. For instance, if he understood how a beverage company earned profits, but couldn't wrap his head around a complex tech business, he'd simply move on. Graham also championed diversification. He recommended spreading investments across 15 to 30 different stocks in various industries. This way, if a few investments perform poorly, the others can help offset any losses. Diversification is like having a safety net that keeps one mistake from wiping out your entire portfolio. A final, crucial lesson: control your emotions. Graham warned that when markets soar, investors often get caught up in excitement and overpay. And when markets tank, panic can drive them to sell at the worst time. He insisted that decisions should always be grounded in careful analysis, not driven by fear or greed. What if analyzing individual stocks sounds too complicated or time-consuming? Graham suggested index funds as a smart alternative. Index funds invest in a broad range of companies all at once, giving you instant diversification and exposure to the overall market without the hassle of picking individual stocks. These strategies are what made Benjamin Graham a pioneer of value investing. He empowered everyday investors to protect their money and build wealth steadily, and he mentored legends like Warren Buffett, who credited Graham's teachings with shaping his entire investing philosophy. So, you might be wondering, does Graham's approach still make sense today, with all the changes in technology and the global economy? The answer is a resounding yes. Even in today's fast-moving world, markets are still ruled by emotion, and opportunities still exist for patient, disciplined investors willing to look past short-term noise. In the next section, I will walk you through how to apply Graham's method in real life, step by step, so you can start identifying undervalued companies, calculate your own margin of safety, and build a resilient portfolio. Stick with me, because this part could redefine how you approach investing forever. It's time for the most important part, putting his ideas into practice, even if you renew to investing. Now that you've learned how Benjamin Graham calculated a company's worth and why a margin of safety matters. The best part? You don't need to be a financial guru or have tons of cash to start applying Graham's principles. All it takes is following a few straightforward steps and staying disciplined. Let's get started. Step 1. Focus on strong, consistent companies. Look for businesses that show steady and growing profits over several years. This stability signals that the company has a solid foundation. You can find this information in annual reports or websites like Yahoo Finance and Investing.com. Step 2. Find the average earnings. Add up the earnings per share over the last 5 years and divide by 5 to get a more reliable average. For example, if earnings were $4, $5, $6, $5, and $6, the average would be $5.20, giving you a realistic sense of the company's profitability. Step 3. Estimate fair value. Multiply that average earnings figure by 8 or 10. If average earnings are $5.20, the fair value lands between $41.60 and $52. Step 4. Compare with today's market price. Check the current stock price. The market price is $30 and your fair value estimate is $50. That 40% difference gives you a comfortable margin of safety. Step 5. Check the company's debt. Avoid businesses carrying excessive debt, since they're often the first to collapse in an economic downturn. Look for companies where total debt is reasonable relative to earnings and assets. Step 6. Build a diverse portfolio. Spread your investments across 15 to 30 companies in different industries. This reduces the impact of any single company's poor performance on your overall results. Step 7. Be patient. Graham's method is about playing the long game. His advice was to buy quality stocks at attractive prices and give them time, sometimes years, to reach their potential as the market recognizes their true value. Step 8. Reinvest your dividends. If your stocks pay dividends, use them to buy more shares instead of cashing out. This reinvestment snowballs your gains without needing to invest more of your own money. Step 9. Stay calm during market ups and downs. Markets naturally swing, but reacting emotionally can cost you dearly. Instead of selling in fear when prices drop, remember that market downturns can be opportunities to buy more of good companies at discounted prices. Step 10. Keep learning. Finally, never stop educating yourself. Read books like The Intelligent Investor, study company reports, and deepen your understanding of economic trends. Knowledge strengthens your ability to make smart choices and protects you from costly mistakes. By following these steps, you'll be embracing Benjamin Graham's philosophy, one that has safeguarded investors for generations and helped build lasting wealth. Remember, successful investing isn't about rushing for quick wins. It's about steady, thoughtful decisions, sticking to a plan, and letting time work in your favor. Now, I want to hear from you. Have you started investing? Do you already use concepts like the margin of safety in your strategy? Share your experiences below. I'd love to know how your investing journey is going. And if you found this video helpful, don't forget to subscribe and turn on notifications. In the next video, I'll reveal how Benjamin Graham's guidance helped Warren Buffett transform small amounts of money into billions, and how you can adapt these same strategies to shape your own financial future. See you in the next video.